Well, it's a pleasure for me to be here. First time for me at the University of Texas at Austin. This is one of the schools. I started as an engineer. I grew up as an engineer. I still think of myself as an engineer. Yes, I'm a venture capitalist. Yes, my job is to manage money. But I had two heroes when I was growing up, Alan Turing and Dijkstra. How many people have heard these two names? Several people have heard. One of those names, of course, is from here. And so it gives me a great pleasure to be here over here. Thank you. Thank you for inviting me. Let me start with a little bit of background on Foundation and what we do in venture capital, and then I'll focus on clean tech and investing over there, and particularly on financial models and how they work in the clean tech space and some of the complexities that have come to that from the venture side. So Foundation Capital is an early stage venture firm. Early stage for us means two guys, a PowerPoint, and a dog. Three of the companies that Varun mentioned were incorporated after I made the investment decision. We are very early stage investors. We start literally before even companies are incorporated, right when people have an interesting idea, often straight out of universities, and we will invest in them. We manage $2.5 billion. We are 9 general partners. I'm one of the 9. We manage the firm. So it's a fairly significant pool of capital per partner that we are looking at. Starting at very early stages and then growing them all the way through IPO into long-term, standalone, independent companies. That is the dream of every venture capitalist, to build a company long-term, standalone, independent. Dell is a local company, of course, which is very famous over here in Silicon Valley. You know, we're all talking about Facebook these days. It's going to go public one of these days. Those two are not companies that we have invested in. But how many people over here have heard of Netflix? Maybe some of you are customers of Netflix. That's one of our companies. We're very proud of them. A company in the consumer space. How many people have heard of Atheros? Atheros Communications. I see a few hands over here. $3.5 billion acquisition by Qualcomm last year. That's a company that was incubated and started in our offices straight out of Stanford. Obviously, Teresa Ming did the research originally on bringing, building radios on CMOS. Directly, and so became a very successful company, went IPO, and now is a part of Qualcomm going forward. So that's what we do. That's really what Foundation Capital is about. Taking some innovation, starting right in the university or a lab, and taking it all the way to an independent company. And to do that, we look for 4 things when we meet a new entrepreneur, when we look at a new company. For us, there are only 4 criteria that matter, and they are: 1, market size. How big is the market that this company is going after? A company can only be as big as its market. It can't get any bigger. So market size, really critical, really important to understand how big you can be. Number 2, team. Team is a highly subjective opinion. You have to look at a person, you have to sit and watch and try and imagine what this person will be like 10 years from today. With $50 million in capital, lots of hard work, luck, some experience, also called bad luck sometimes, along the way. And that's what really a successful venture is about. So it's a very subjective judgment. It is an opinion, and it is often a contrarian opinion. Good investing comes from contrarian instincts. If everybody's doing the same thing, it's not a good investment. It's usually too late to make that happen. So we are looking for contrarians, and the simplest example of that is looking at a person who is, let me describe a person to you. Here's a person who's a bit of a loner. He's stubborn. He's hard to get along with. Wants to go his own way. I'm saying he because most often it's he. Sometimes it's she, by the way. I have some good examples of that too. Hard to get along with. All the references say difficult to work with. What do you say to a person like this if you're doing a job interview for a PR position in your company? How many people would hire a person whose references said that for a PR position in their company? I hope you never do, because that would not be a good hire. How many of you would hire that person as an entrepreneur? In other words, give them your own money, go after them, and say, go make money. I believe you when no one else believes you. Those are characteristics of good entrepreneurs. They are often loners. They are often hard to get along with. They are often brilliant. They're often perceived as stubborn or obstinate. Now, the difference between being stubborn or obstinate or being persistent and diligent is a very fine line, and it is often in the eye of the beholder. So it's a subtle distinction. That's a distinction we like to make. It's a distinction we believe in, and it's the second most important criteria since we are often investing at such an early stage in the companies. So very quickly, the 4 criteria. First, market size. Second, team. very subjective. Third, barriers to entry. A company's value depends on how hard it is later on for competitors to compete with that company. You don't need barriers to entry if you're 5 people building a small product. You can get away with it. You don't need barriers to entry if you're going to run the corner laundromat. That's a business which can run with low barriers to entry. It's a hard business to scale. If you want to build a $100 million company, if you want to build a $500 million company, and certainly if you want to build a $1 billion company, there are going to be competitors. And those competitors better be stopped with good barriers. So we really look for barriers to entry. And today we are not going to talk about what makes good barriers to entry, but you can imagine some of these, things like patents and good strategic and network effects and things like that. But today we won't discuss those, but those are examples of barriers to entry. And last and most importantly, financials. Financials, because my job is to buy low and sell high. My job is to make money for my firm. And so financials are very important. They're very important in terms of the stock we purchase in, the investment we make, and what happens to the company, and where does the company grow to, etc. But they are also very important to the success of a venture from a business perspective. What are the gross margins that will exist in this company long term? What will the business look like when this company starts scaling? Will it have high gross margins or will it have low gross margins? I can assure you, your corner laundromat has low gross margins. It is almost the poster child of a low gross margin business. I can also assure you that Microsoft has high gross margins, Facebook has high gross margins, Netflix has high gross margins, Dell has high gross margins, Atheros had high gross margins. Why? Because they are strong barriers to entry, they are high gross margins. That's how you build highly valued standalone businesses long term. So that's something we look for very carefully. Those are the 4 criteria. These are pretty universal criteria. Notice that I didn't talk anything about software or semiconductor or energy or clean tech or any particular sector. These criteria are universal. They don't really apply to a particular sector or a particular technology. They don't apply to a particular geography. They don't apply to a particular stage. These are pretty universal criteria. They make for good investments. So that's what we look for when we go out to make an investment. Let's now talk about the clean tech space. Clean tech is a sector which was till recently was sort of new to the venture scene. Till about 5 or 7 years ago, it didn't really exist in sort of popular parlance as an established category in venture. Then it sprang on the scene. There was an enormous amount of activity in clean tech. A lot of money went in. And then I would argue that today clean tech as a sector is out of favor. Just yesterday, BrightSource Energy announced that they're going to pull their S1. This was one of the very successful companies doing well, going out, expected to get hopefully a high valuation, and they've pulled their S1 now. It's never good news when you pull your S1 and you decide that you're not going to go public anymore.
What is an S1?
Thank you, Varun. Sorry, I take that for granted. Thank you for bringing up. S1, I don't know what the technical name of the full name for that is, but it is a form that you file with the SEC when you decide to take a company public. So it's a registration statement. Prior to taking it public, it's a form which describes your business, the risks, the financials, and it is the basis on which you go and recruit investment bankers who then take your company through the registration process and you start trading as a public company. So it's a very important document. It is often prepared with great care, with great pride, with great expectations when you go out and you post it on the Edgar website, on the SEC website, and you say, now I am almost ready to go public. And you go and do that. Pulling an S1 means that they have gone and updated the document to say that we are no longer active, we are not planning to go public for the foreseeable future. So it's a tough event. Now I have no inside knowledge of BrightSource, we are not investors, I really don't have any particular information about them except to use them as an example of a company which has now pulled their S1 and as an example of a company which is sort of showing what has been happening in the clean tech sector, which is tough financial times. So why is that the case? So let me approach that from a financial perspective, simply from the structure of an investment, how much money went in, what happened. And let's start from the ground up. Let's start with what is a typical Silicon Valley, and I'll use Silicon Valley just because I'm based there and that's what I'm most familiar with. But frankly, I am very sure that we compete with good firms over here in Austin and Boston and New York, and these models are pretty much the same. So, but I'll just use Silicon Valley because that's what I'm used to, I'm using over there. So let me draw over here for you very quickly the simple formula for what a traditional Silicon Valley investment used to look like. $20 to $50 million invested. $30 to 70% ownership by the venture capitalists, meaning the founders, the employees, the others would own the flip side of that, which is the other 30 to 70%. And an outcome in the quarter to three-quarters of a billion-dollar range. This was the bread and butter formula for Silicon Valley. This is how we did software, this is how we did semiconductor, this is how we did SaaS, this is how many sectors, disk drives originally in Silicon Valley worked. This is not Facebook, this is not Google, this is not VMware. These are all good, successful venture-backed companies, but those were the high flyers. Those were the unique events that prove the venture model and eventually make venture firms work. These are bread and butter deals. These are companies which are good successes. You make 10 times on your money. You have good ownership. The founders walk home with $10, $20, $50 million, so they are rich people, but they're not Mark Zuckerberg, they're not Larry and Sergey at Google, they're not the people who are the unique, special entrepreneurs who took it all the way. This formula worked well. It is highly compatible with the venture model. So we are going to invest between $20 to $50 million. There's typically 2 or 3 venture firms in the deal. So each venture firm is putting in between $10 to $20 million in that $20 to $50 million range. They're going to end up with ownership between 30 and 70%, which will be shared between those venture firms. So they'll have some amount of ownership. The earlier stage people might try for 20 or 25%. We like to go for 20 or 25%. The later stage people will go for 10 or 15%. So that's kind of how it will work. And you will have an eventual market cap in the $250 to $750 million range. In other words, we will share in the profits. Let's say at the middle point of that, $500 million would be shared. And if I own 20% of that company, $500 million, 5 times 2, that's what I am going to take home at the end of the day as a return on investment that I've made. It's a good formula, it's a good way to make money, and frankly, it's a formula which has worked for many years in Silicon Valley. This formula started breaking down when we went to clean tech. But before I get to clean tech, I'll start with another sector, which is a little bit easier to parse than clean tech, and that was semiconductors. So semiconductors, semiconductor investments started going out of favor about 10 years ago. And the reason was that this number started moving up. Now recall, I mentioned Atheros, which is one of the companies that we did, a good semiconductor company. I actually don't know the exact number of total amount that they raised. I do remember that they went public for a $400 million market cap, so they're still in this range in terms of what they were. But this number for semiconductor started going up. Semiconductor companies started taking $50, $70, $80, $100 million, $150 million before they made it. Well, that's really hard. If you have to put $150 million to work and you've only made a $500 million company, the risk reward is no longer in your favor. Remember, you have to account for failures, you have to account for companies that don't work, companies which come out on the low, etc. So that's just not a formula that would work. And so semiconductors started tracking down. And today you will find there is much smaller amount of investment in semiconductor. It's still made. We still have semiconductor investments. Just last year we invested in a semiconductor company. And the reason we can do that is either we believe this number will be smaller in that particular case, or we believe this number will be higher. Otherwise it doesn't work. Very simple math. If you're lucky or perhaps smart or both, this will be smaller and this will be bigger, and then you'll have a really nice big investment, right? That's when you make a lot of money. That's what we all try and do as venture capitalists. That is what is going on in the semiconductor sector today. People trying to invest either smaller amounts of money, have the same outcome, or invest a large amount of money in the belief or hope that you will have a very large outcome for whatever reason you believe that will be the company that will be built. The reason that could work in semiconductor is because the profile of the outcome of the company was still very similar to a traditional high-tech company. These are companies which had high gross margins, they had high revenue growth, and very high productivity per employee. In other words, you didn't have to scale the number of employees or the number of factories or the number of plants once your product was working. With semiconductors, it's typically chips. Once you had your chip right, it might take more money to get there, it might take longer. Once you had the chip right, you just had to ship it off to Taiwan or ship it off to China, and you could make a whole bunch of them really cheap, right? Because that's the magic of chips. I mean, that's the magic, that the cost of making a chip is really cheap. If you can sell it at a high price, you still have high gross margins, you can still work the business. Clean tech was different. When clean tech came in, there was a political imperative. We had the Kyoto Protocol, we had green, there was a lot of worry about carbon dioxide. Now, I'm not a geologist or a scientist, I'm an engineer, so I don't know whether that's true or false or right, but there was certainly, the newspapers were full of that information. The media was full of that information. Plus, we had political imperatives like the Kyoto Protocol, like pressure in terms of deciding what we are doing. And then, of course, there are political imperatives like, is oil good or oil bad? Should we import oil or not? And regardless of what your politics are, the fact is that it was in vogue, that people decided that we want to do it, we want to invest money in this. And so an enormous amount of money was invested in the clean tech sector. And what happened over there is we saw genuine innovation. Great companies are built with genuine innovation. We saw genuine innovation in those companies. But what we also saw was a lot of traditional industrial companies masquerading as clean tech companies. Now, it's easy to, we call it greenwashing in our business. It's easy to take a company and just call it a green company. You can justify in some way, shape, or form that you are saving energy or creating energy or saving oil or saving the planet in some way. And there are some very good creative writers who will write a paper or write an article which will justify anything as green. So we call it greenwashing. There was a lot of greenwashing that happened, and it brought a bad name to the entire sector. But let's look at this sort of recast industrial sector in the clean tech space and see what happened on it from the venture side. These were companies which were working with industrial processes. If you have an industrial process, you typically have to build a factory, you have a plant, you have working capital, you have factories which are going to take workers, inputs, there's cost of goods sold, there's all of these factors which you have to consider when you are running it as business. That typically translates to a lower gross margin business. Not always true. I'm not stating that that is always a limitation, but it is often the case of what happens over there. And there were a lot of business plans funded that had those characteristics. A classic example is, of course, in solar manufacturing. We had a lot of companies which were funded where they were tweaking what it takes to improve the efficiency of a solar cell. Now, that's a good thing. Improving the efficiency of a solar cell, that's a good thing. If you can make it work, if you are dramatically better than everyone else, that is a fundamental innovation. It is a company which you can build. But if you have built it only a little bit better, then you're still going to be competing in a commodity market. You've got to deal with all the issues of manufacturing, all the issues of scaling industrial processes, building factories, building plants, doing all of those things. That's a tough business to be in, and scale it with venture capital. Why? Let's answer that question. The reason was these companies took a large amount of capital. We saw in clean tech, venture capital companies, companies funded by venture capitalists, where this line was very, very large. $100 million, $200 million, $300 million going into a business to be in, with the hope and expectation that it would return venture-style money. In other words, it was risk capital. This is not money that is guaranteed. This is money that we can lose when we invest in that company. They went in and they tried to build, using innovation, well-meaning people, working hard, building factories, trying to sell a product which may or may not be economic. There may or may not be buyers. Perhaps it needed a regulatory enforcement, a regulatory structure to make you want to buy that product. Perhaps it needed incentives. The government has to give you a tax credit or a benefit or an incentive or a subsidy which will make you want to buy that product. Well, we are always worried when we see something like that, because that is a non-economic decision. That is a decision being made for political reasons. And I don't control politics. I don't know who does. Whoever does, please let me know. I'd love to know someday how it all works. But it's up there in DC somewhere, and somehow it works. We don't pay a lot of attention to that. I'm an engineer. I pay attention to universities. I pay attention to labs. I pay attention to technology. That's where we build those disruptive companies which can go and really, really make a change without help of subsidies, without help for regulations forcing people to do that. When we started Netflix, when we started investing in Netflix, we didn't go to the post office and said, please give us a discount on the cost of the stamp. We didn't do that. When we looked at the business plan, we said, Are people going to want to get DVDs by mail? By the way, a 200-year-old technology. I mean, mailing letters is not a new technology by any stretch. People have been doing it for a long, long, long time, okay? But when we studied that business, we did not look for subsidies. We were not looking for regulatory approval to make that an economic business plan. The value to the user, some of you over here are customers, was obviously enough that you were willing to pay enough money that we could pay for mailing those DVDs to you, building the plant, building the factory, churning all of that stuff, and yet make money and make profits. That's what made it a profitable business model. In the clean tech space, a lot of business plans were predicated on the existence of subsidies, and that has been an issue. That has been a problem from a venture perspective because it introduced an enormous amount of political risk into the equation. So that's a risk factor. It's happened. It hasn't played out well in a lot of cases, and that's just unfortunate that is the case. But I was mixing two points over here, and I want to make sure that I separate them now, and I explain what happened in the clean tech sector on the capital line. So these are companies which took a lot of capital, wanted to build factories, wanted to build plants, sometimes with regulatory help. I mean, Solyndra is probably the most public example. How many people have heard of Solyndra over here? Okay, everyone's heard of Solyndra. So very public example, the subsidies going all the way to a direct cash injection by the government in a company. I mean, that's the ultimate form of subsidy, right? It's like the government comes and writes you a check. So nothing better than that in terms of getting subsidies. So large amount of capital required to go and make that business scale. And look, I don't know anything about Solyndra on the inside. We are not investors. We didn't participate in any way. So I don't know whether it was good or bad, right or wrong, or where things happened over there. But the success of that business was clearly predicated on the existence of that cash. That's a problem. That's a problem because then our model breaks down, and so we can't make money, and so we can't invest in that space. Now there are exceptions. I'll talk about two exceptions. These are companies which we have invested in. So the companies are Sunrun and Azure Power. Sunrun is a company in the residential solar space. How many people are familiar with Sunrun? Quite a few people. Wow, that's wonderful. Azure Power is a company in India, so you're probably not familiar with that. Doing something very similar to Sunrun. So I'll focus primarily on Sunrun today. We can talk about Azure a little bit. Here's a company which went and noticed the following discrepancy which existed, or inefficiency which existed in the market. The price of solar panels had come down because of enormous investments in solar panels and research and R&D, and lots of work was done over there, lots of companies funded over there. The price of solar panels was coming down. The retail rates of electricity were very high, to the point that if you could take into account the cost at which, the highest price at which electricity was being sold in the retail sector, it started to make economic sense. Most importantly, there existed a tax credit, a form of subsidy. There existed a tax credit for solar. However, this tax credit was primarily only available to corporations for various regulatory and structural reasons. It was only available to corporations. So here I am, a homeowner who lives in sunny California or sunny Texas. I live in California. I pay, these are not true numbers for me specifically, just full disclosure, because I live in Palo Alto, which is a little weird city on its own. But in general, in California, we have very high electricity rates. Not true for Palo Alto, but for the rest of California, we have very high electricity rates. At the peak rate, I'm paying 12, 15, 18, even above 20 cents a kilowatt hour for power. I have lots of sunshine on my roof, but I can't take advantage of the tax credit because I'm just a homeowner. I have a garage, I have a car, I have a house, that's all I do. I go for a job, right? Next door to me is a corporation. It's paying lots of taxes. It would love to take advantage of this tax credit, but it can't because it's not buying electricity at the residential rate. It's not paying for electricity at the residential rate that the neighbor is at. So what Sunrun started with was the premise of saying, how can I create a market, create a company which solves this problem? So they created a structure, a financial structure, which is essentially leasing of residential solar, which allowed homeowners to sign a long-term lease where they didn't have to take on any of the headaches, any of the hassles of sourcing the solar panels, maintaining them, buying them, making sure that they really are working every day and that they really are getting the net metering effect and the utility is not really charging them extra for the electricity, etc. Lots of little arcane details that every homeowner doesn't want to deal with. They take all of that headache away from the homeowner. They go to large corporations and say, you're already paying all this money in taxes. Here is a structure which will allow us, Sunrun, and you to partner and use this tax equity structure, and we can then create a marketplace where homeowners, these corporations, and us all have a benefit, and we'll all share in the benefit that exists over here. That is at a very high level the Sunrun. That was the insight on which Sunrun was started. It's a very successful company today, doing well and obviously growing rapidly, and so we're very excited about the prospects of Sunrun over there. But here's where the capital required for Sunrun became a problem. Buying solar panels is very expensive. The payoff for solar panels is many, many years, depending on geography, territory, location, what regulatory regime you're under. It could be as little as 5 or 6 years or as much as 11, 12, 13 years. Well, the good news is solar panels last for a long time, almost always at least 20, 25 years. So it makes sense, it makes economic sense to do it. But you need a large amount of capital up front, which you're going to tie up for this long period of time. So what do you do as a venture capitalist when someone walks into the doors with you, in this case Ed and Lynn, smart guys, guy and gal, walk in, they want to start this company, we are the Series A investors, and we're saying we can do this, but we're going to need $1 billion in capital just to buy solar panels. Well, I don't have $1 billion to give you. I mean, we have $2.5 billion, but I'd like to invest in 141 companies. That's our current portfolio with that money. So how do you solve that problem? That was a problem for Sunrun, and the way they solved it is by effectively creating a separate balance sheet, a separate structure for tax equity, where Sunrun itself doesn't own the solar panels. The solar panels are owned by this other entity. It sits off of the balance sheet of Sunrun. It sits on a separate balance sheet. It's a tax equity structure, and we're not going to get into the gory details of how it works today, except to say that the P&L for that ownership is tracked separately, the taxes for that are tracked separately, the payments for that are tracked separately, and there's lots of legal paperwork and lots of lawyers made lots of money making sure that all the liabilities and responsibilities and the future issues are all taken care of. So it's really a win-win-win scenario. So that's how it worked. Fairly simple. There's no big blinding insight there other than lots of detailed work making sure that all these three parties could each get the benefit that they were looking for and contribute what they were willing to contribute and make it work. So the solar panels are the capital for solar panel comes from tax equity. Tax equity is a fund which is raised by Sunrun, which is paid for by corporations which want to invest money in the fund. Typically we work with bankers and there'll be multiple investors in that. And that is the entity that owns the solar panels. Is that clear? Okay, thank you for asking. By the way, if people have questions, please jump in. Don't be shy. So it's I'm happy to dive in here. Question. That's a great question. That is a fabulous question. So what is the barriers to entry for Sunrun? Let me answer that question a little bit in the abstract, and then we'll talk about the specifics of Sunrun. And on the very last step for Sunrun, I will actually not answer the question because it's still a private company, and I don't want to give away some private data there. So let's start with the general observation. Barriers to entry, like I said, are critical to building a long-term large business. Another characteristic of barriers to entry is that they change over time. So when a company starts, it may have a different barrier to entry than when it's at a certain size or a certain stage, and then a different barrier to entry as it gets to a certain size and stage. So it's very important to understand that a barrier to entry is not a static thing that you evaluate on a certain day. A barrier to entry is something which evolves over time, and you have to evaluate it from that perspective. So in the case of Sunrun, what were the barriers to entry? On day 0, they were the first. They invented the model. So the barrier to entry was simply being first to market. That is a barrier to entry. It has a very short life. Typically, competitors will come into it, and we don't consider it a great barrier to entry. But it is a barrier to entry, and that's how it often starts. They had another barrier to entry. They had Ed and Lynn Zurich. Lynn is brilliant. Ed is smart. I mean, that is a barrier to entry. Do not underestimate the value of that barrier to entry to a venture capitalist who is going to invest literally in a PowerPoint and 2 people. I want to see someone who will be innovative, who will be creative, who will come up with something new the next day. When the antitrust battle was taking place for Microsoft, some of you may not remember it. I think you're a little younger, or perhaps you were a tech geek like me and watching it when you were in 8th grade. Microsoft talked a lot about innovation. Microsoft spent an enormous amount of time talking about innovation. So that is a barrier to entry, which is how many new products can you create? What other innovation can you have? What research can you do yourself to continue to create that? So that is certainly a bet that we are making when we make an investment in a company. In the case of Sunrun, the efficiency of their business model to the venture capitalist is an enormous barrier to entry advantage, is a competitive advantage that is very attractive to us. So they have competitors who are vertically integrated. It's an alternative business model. They carry the entire balance sheet on the books of the company. So there are companies competing with Sunrun where they are vertically integrated. They hire roofers, they hire electricians, they hire people who go out there, fix the wires, plug the stuff in, and will purchase the panels and carry the entire balance sheet, the entire cost of the solar panels on their balance sheet. There are efficiencies of scale in that business, but it is a less efficient model in terms of the amount of capital that balance sheet requires. So it's a different model. For reasons which are a little bit second order and take some time to motivate, to a venture capitalist, low capital business, in other words, a capital efficient business, is always a better investment. It always results in a higher multiple. So the probability of win is always higher, because I'm playing a probability game. I'm looking at it from the perspective of what is the probability of getting the maximum amount of multiple and maximum amount of return on my money when I'm making an investment. And so to a venture capitalist, that's much more attractive. From a regulatory perspective, if I was in the government, I would say, well, there's no difference. I don't care. Sunrun, SolarCity, vertically integrated, an outsourced model, they're all the same. At the end of the day, we're all Americans. There are American roofers who are out there installing them on American roofs, installing hopefully American solar panels, saving good American money. And so I'm happy, because that's my job in the government. So I'm neutral if I'm in the government to these 2 models. But I am not neutral as an investor. That's the difference that I'm trying to make over there. So from different perspectives, you may evaluate the same model and come up with a different answer over there. So the barrier to entry for Sunrun long term, clearly they have a very efficient marketing machine today. They have nailed some of those issues, which is well and public information, which I can share. And the last step I'm not sharing, which is their long-term scaling model, which is a barrier to entry that they have, which gives us enough confidence that I today have $31 million invested in the company. So I'll just cut it off at that over there, and I'm sorry to have to do that. Maybe after they're public and we've sold their stock and it's a story, like we can talk about Atheros or something one day, we can do a case study on it. But unfortunately, I can't take it any further than that on that question. I'm happy to dive into questions. I see another question over here. So let's take that and we'll come back and see how to do this.
When you talk about barriers to entry, so you're talking about creating a competitive advantage that includes another company from competing against them, or are you talking about barriers to entry as hurdles they have to overcome to show profits that you can achieve?
Both. Both types of barriers to entry are critical to success. The barrier to entry that I assumed you were referring to over here in front of you, and the ones that I was talking about earlier, were barriers to entry to competitors coming in, because that is what will eventually determine the valuation of the company. Companies which have strong barriers to entry have high valuations, obviously because they're expected to have high profits for a long period of time. If you have low barriers to entry, then you'll have a lower valuation. So just from that very simple, investing 101, I want a high valuation long term. You want a business which has a high barrier to entry. It's just literally that simple. And from that perspective, I was talking about what are the different barriers to entry. The barriers to entry in terms of what are the hurdles which have to be overcome to build this business for the company itself, we would categorize in the section of what is the probability of success. When we make an investment, we undertake a certain amount of risk, which is, in the generic venture formula, more often than not, you lose money. In other words, I am usually wrong is another way of saying what I'm saying. More often than not, I have made a mistake when I have made an investment. That is the venture formula. Unfortunately or fortunately, that's the negative way of looking at it. The positive way of looking at it is that when I am right, I am at least 5 times ahead or 10 times ahead. So it's okay to be wrong 4 or 5 or 6 times if I'm okay 10 times ahead when I am right, which is why, of course, venture capital works. But it is predicated on making a lot of mistakes. And so we are happy to take a fair amount of risk. A pretty extreme risk is fairly common in the venture business. Probably the only people who take more risk than us are, true sort of breakthrough research in the form of universities, research labs, government labs. Those types of research is undertaken, which is where innovation often actually genuinely starts. Venture capitalists, in my opinion, are really not investing in the innovation itself. They are investing in bringing the innovation to market. I mean, it's that last step that we invest in. I think it's a misnomer to say that venture capitalists are investing in the core innovation itself. The core innovation is often in a university, often in a research lab. That's really where the real work gets done, where these companies get started.
So on that note, Ashmeet, I'll ask you 2 questions,
Mm-hmm.
then we'll open up to the audience. First is, where do you see the role of government? So you said you're a very early stage venture capital. You just almost pick companies out of the lab.
Mm-hmm.
We know the role of government is there for basic R&D in science and technology, for even for applied research.
Mm-hmm.
But if you are picking out companies from the lab, is there any role for the government in that space?
So, there is some overlap between what the government does and where our work starts because we are such early stage investors. We had the first Department of Energy Entrepreneur in Residence, EIR, ever, which the government did, was a foundation capital EIR, Michael Bauer, who is now running a company for us, Sentient, that we invested in. He spent 2 years at Oak Ridge, Lawrence Livermore, and I forget the name of the third lab, looking for innovations and ideas that he could bring out of the government and then start a company with. As it turns out, he ended up not pulling anything out, but starting a company with something else. But the fact is, the real research, the breakthrough ideas are done by universities and governments in labs. They are often not well equipped to make sort of the market decisions that are necessary to make them commercially successful. And I think that's where venture capitalists specifically, but in generally speaking, the market or capitalism in general is very effective. The invisible hand works extremely well at making and picking those and making them successful. And that overlap is right at that edge where you can start a company and start a business. If somebody comes to me, one criteria on which often we will say no to a business plan is it's a science project. We don't mean that in a derogatory fashion, we just mean it's too early. We just means that you still need to do science. You are still working on something which may or may not work to enough of a degree that we would be comfortable investing in that. So it's still a science project is one reason why we would say no. They're still on the other side of the line. When they cross that line, it's not a science project anymore. There's lots of risk. It may not still work. The technology might not work. The engineers may be wrong. Our initial estimates may be wrong, etc. There's lots of technical risk, but it's not a science project anymore when we invest.
The second question I have is, we have heard a little bit on what the experience has been in the clean tech space. What does it look like for the future, for the next 5-10 years?
That's a great question, Varun. And as I mentioned earlier, I think the sector is out of favor right now. That's clear simply by looking at valuations. We had one of the first clean tech IPOs in the industry. It's a company called Enernoc that we invested in. It went public. A nice company. It traded up. I think at one time it was worth about $1 billion or above $1 billion. I don't remember the exact number now. So a very nice success for venture capitalist perspective. Just today I was looking at the market cap coming in, and it was about $170 or $180 million. This is the same company, which still has the same CEO. Now this is a public company, so I'm not going to say more about them, except to say that the sector is out of favor. That's very clear. over here. The unknown question is this a cyclic, is it just simply a cyclic issue? In other words, is it just going to come back? Or is this a structural issue in that it really is not a sector per se? It really would not have continued. I think the jury is out on that. My personal opinion is that the sector is overfunded. There is space for clean tech, but it is a much smaller sector than it has been in the past. In other words, the part of it which is cyclic is much smaller. The part of it which is not coming back, the structural part, is much bigger, which will not come back. I mean, we cannot sustain 100 companies working on algae. That's just not going to happen. It is not sustainable on a venture capital basis. It is sustainable on a research lab basis. I mean, there's nothing wrong in doing 100 experiments or having 100 labs in the country working on algae to try and build some form of biofuel. And if you can do it, you can change the world. I mean, that's just a fact. But that's not a venture capital model. So,
can take questions from the audience.
Question.
Curious to know, when you're investing in these very early stage companies, how much management control does your firm prefer to have in these companies? And if you do have management control, how do you structure it?
That's a great question. So our preference, and this is a cultural or an opinion in terms of how good investments are made, is to have no control or minimal control. Our term sheets are typically less than a page. I have never seen a term sheet longer than a page and a half at Foundation Capital. I've been there for over 7 years now. We are early stage investors. We are highly aligned with the entrepreneur. What's good for the entrepreneur is good for us. What's good for us is good for the entrepreneur. There's very little that's, where we are out of alignment. So we don't go for control. We will often take board seats. Almost always we will have board seats, minority board seats, mostly as a value add. Mostly because we are all ex-operating people. We believe we can help you, we can help the entrepreneur. Certainly at the earlier stages of building the company, when you are still a $1 million business, a $10 million business, a $100 million business, we can help you. Once you cross $200-300 million in revenues, we don't want to be on your board. We don't want to, I mean, our job is done. We're done. We're all going to be happy. You've built a successful business, and if you keep going all the way and you're Reed Hastings and you want to keep running, Netflix for the next 10 years, more power to you and God bless you and go for it, But our job is done. We're off the board and we're done. So that's the way we look at we look at it from our perspective. We are not control oriented because we are also not financial investors. So we take enormous risk in terms of trusting the people, trusting the technology, and betting that we will be right. And I'm proud to say that in the entire history of Foundation Capital, in all the investments that we have ever made, actually this includes a predecessor firm also of ours, we have never ever, we have lost money many times, lots of times made mistakes, but we have never ever been cheated except once, when we had a thief, when someone actually lied on what happened and that person ended up in jail, and it's a long story. But only once, which is, till a few years ago I could say never, ever, ever, and get away with that. Unfortunately, there are some people sometimes who will cheat you, but it doesn't happen. And that's a wonderful thing. To me, it's a wonderful thing to have that trust and to have that willingness and ability. And I can tell you, if I may make a very personal comment over here, I'm an immigrant. I came to this country. I have seen many, many countries, many environments. I have traveled a lot. That is not true everywhere in the world. It is a wonderful thing about our country here. As an American, I can say that now. As an American citizen, it is a wonderful thing that we have this trust, we have this ability, we have a nature that we work over here, where that is often the case. You can't say never the case. There are a few bad apples, but often that you can work on trust enough that we continue to work effectively on trust over here. So the question is, how do we evaluate political risk? It's actually very easy to evaluate. If your business plan doesn't stand on its own economic merits, there isn't a hard ROI. And I'm not talking about being 1% or 5% or 10% better. If you're not 10 times better than what exists out there, it's not a startup. Because believe me, the big guys are going to get you. I mean, you can say the big guys are slow and they don't move as fast and those guys aren't as smart. And believe me, they're not that stupid, they're not that slow. There's a reason they're big, okay? I used to work for big companies. I work for big companies, small companies. I know why they're slower and why they look lumbering. They're not so lumbering. So if you don't have it's 10 times better, it's obvious, there's some other reason on the basis of which you're going to run your plan, and then there's risk. So it's fairly obvious. It's not so hard. The two most common reasons why we are wrong, so the question is, what are the biggest failures and what goes wrong in our investments? I'll preface my answer by saying we are early stage investors. You will get a very different answer from later stage investors. So people who invest in Series B and Series C rounds and later stages in the evolution of a company will give you very different answers. For us, the two most common reasons why things don't work out, the number one reason is it doesn't work. In other words, it was a science project. We thought it wasn't, but it was. It actually didn't work, even though we had convinced ourselves that it was almost about to work and the risk was manageable. And number two, market size. We made a mistake in evaluating the true market size of the product. It is really hard to do that. And as much as we think about it and try and solve that problem, more often than not, we will sit there, look at a company and go, we were wrong. The market just isn't big enough for what we are doing. They're smart people. There is a real value add. It's compelling, but it's a small market. So that is often the case. It's a great question, which is how did we estimate the market size for solar PV? So for us, market size is always bottoms up. Market size is evaluated, in this case, pretty much state by state because it's regulated at the state level. In some cases, county by county, but mostly state by state level. And we were clearly comfortable for a host of reasons, including taking some political risk because there is regulatory risk in this case. We didn't know whether the tax equity would be continued or not. It was, as it turns out, when we made the investment. So we took on some political risk in this case. Look, we're not dogmatic. We're not saying that we'll never do that or that's out of bounds. I'm stating these as general principles, rules of thumb, things to think about, with the biggest rule of thumb that if you haven't broken any rule, you can't make a good investment. In other words, to make a good investment, you have to break at least one rule. You have to do something different, something which is at least contrary to what everybody else thinks is right. Otherwise, you haven't made a good investment. So in this case, we did take some political risk, and we did estimate the market size, and we have a strong belief that it is a very, very large market. There's no question about that. State by state, how many roofs, at what price, what is the cost of customer acquisition, what is the NPV per customer the net present value, what is the net present value of a customer once you have acquired a customer, and that's the market size. What did it cost to acquire it, what is the current value, multiplied by the number of those customers in that state that we think we can go and get. I mean, it's not a difficult formula. It's all in the estimate. It's like what do I believe will be the NPV, what do I believe will be the cost of acquisition, and where do I come out over there. So
if you were to finish your
so the question is, if you after you finish your MBA, you wanted to be an entrepreneur in clean tech, what sort of role would you be looking for? Let me answer the question for what role should you be looking for to be an entrepreneur, and then apply that to clean tech specifically. So the answer to be an entrepreneur, let's take a few examples. I'll name a few famous entrepreneurs. I think you'll recognize their names, and let's see what roles they had done before they became entrepreneurs. Bill Gates, anyone know what he did before he became an entrepreneur? Harvard dropout, wasn't he? Mark Zuckerberg? Harvard dropout. Oh, well, maybe I should have picked a different one. Bill Hewlett, Dave Packard, started Hewlett and Packard. Anyone know what they did? Students at Stanford. Michael Dell, local person. UT dropout. Okay? I'm not trying to encourage you to drop out. I'm not trying to encourage you to drop out. I can give you examples of some wonderful graduates who went on to become entrepreneurs. I am trying to emphasize the point that there is no qualification to be an entrepreneur. There is no particular requirement of a role, skill, etc. In fact, there are studies which say that if you go too long, if you do too much of something, you are less likely to be successful as an entrepreneur. In other words, there's a reverse correlation with age and experience and entrepreneurship. I don't believe too much in correlations. I believe in people. I believe in individual people. I think an individual, regardless of age, experience, education, domain, can be successful if they really want to do it, and they have some other things which make them successful. So I'm sorry, but the answer to your question is there is no answer, in my opinion, if you want to do that.
You were about to graduate with your MBA.
Well, so you can take the general advice. If you want to be in clean tech, go work for a clean tech company. Spend time with clean tech entrepreneurs. Look at where there's clean tech innovation. Certainly, those are smart things to do. How you achieve that, I don't consider any of them prerequisites. Whether you go work for a clean tech company, whether you hang out at an incubator, whether you go hang out at a government lab, whether you go work, look at where the regulations are being created, because clean tech is so interrelated with the regulatory frameworks where a lot of the companies are being created. All those are good activities and good things to do, no question about it. But they are not prerequisites, so I don't consider them prerequisites. Nice to haves.
One final question.
Okay, let's give you a chance in the back over there. Which is the best geography to make clean tech investments? I hate to I hate to repeat my answer, but there's no reason why a particular geography cannot work. I mean, what was a big high-tech startup company in Seattle before Microsoft? I mean, there's no reason why you have to pick that. I don't think you're limited by geography. That said, there are areas where there's innovation. There's areas where good people hang out for other reasons, and there's some second-order advantages and benefits you can get. So you're not precluded by doing any of those things, but there are areas you can go there. Certainly, Texas is a great place. Austin is a great place because of the venture environment, because of the entrepreneurial environment, because of the existence of the energy market, which is, again, very correlated, especially with clean tech. The Bay Area is a great market because of the venture environment, a tougher market from housing and taxes and sort of other regulatory, sort of second-order regulatory effects. Boston has historically been a great place for innovation. These are all places where lots of good, innovative companies have been started. But these are all second-order effects. They are not first-order effects. It doesn't matter. If you have a good idea, you're smart, hardworking, you are innovative, you work hard, you work at the problem in a creative way, you can start a company anywhere. No limitation or restriction on doing that. So
Remember, we need to vacate the room right away, but let's thank our...
Thank you.